Reliance Inc., ticker RS, just delivered a massive beat for Q2 2026. Like, if you follow industrial metals, this report completely changes the sector's expectations.
Yeah, absolutely. I mean, looking at the top line, net sales hit $4.63 billion. That is a 15% sequential jump.
Right, but the bottom line is where the shock really is. Non-GAAP diluted EPS came in at $6.27, and GAAP was actually a bit higher at $6.29.
Which is wild because management's own guidance going into this was, what, like $5.15 to $5.35?
Exactly. They completely bypass the top end of their own conservative projections. I mean, it's
Yeah.
a 42% year-over-year increase.
And the Q3 forecast is just as aggressive. They're guiding non-GAAP EPS between $6.40 and $6.60. That's 76% to 81% year-over-year growth.
So let's pivot to how they actually achieved this, because you don't hit the second highest quarterly revenue in company history without some serious volume and pricing levers.
Right, you need a highly specific combination there. And what's buried in that $4.63 billion figure is really a masterclass in how product mix can mathematically skew average pricing while simultaneously exploding the actual profit margins.
It's such a fascinating paradox. Like, imagine you land your biggest contract of the year, right?
Yeah.
You sell millions of units, but because of the bulk discount you negotiated, the average price of everything you sell across the whole company actually goes down.
Which usually sounds like a major red flag for a commodity distributor.
Yeah, exactly. But for Reliance, that exact scenario drove this massive earnings spike. I mean, they hit record quarterly tons, sold 1.79 million tons.
That's a 7% sequential increase, right?
Yep, 7%. And management only forecasted a 1% to 3% bump.
Which is huge when you look at the broader market. The Metals Service Center Institute reported industry shipments were only up 5.5%. Reliance nearly doubled that with 10.8% year-over-year growth.
And despite a massive influx of cheaper bulk material, the overall average selling price per ton still managed to jump 7.8% sequentially, up to $2,602.
Right, and the big driver behind that volume surge is the DHS border wall contract.
The Department of Homeland Security one,
Exactly. Keeping this to a strictly numbers-only analysis, the financial footprint of this single federal project is just staggering. It started contributing heavily in April, and it completely outpaced projections.
It contributed 5.1% to the sequential volume growth alone.
Yeah, and on the earnings side, it added $0.41 per share.
Yeah.
That is more than double the $1.15 to 20 cents they originally baked into their guidance.
Wow.
But the mechanical quirk is what it did to the pricing metrics. The border wall contract actively dragged down their consolidated average selling price per ton by 1.6%.
Which brings us back to that paradox. It lowered the average ticket price, but it added about 30 basis points to their pre-tax income margin.
Essentially 1/3%, yeah.
Right. Think of it like a retailer moving a massive wholesale bulk order. If you sell 1 million basic units to one buyer, you give a steep discount.
Your average ticket drops.
Exactly. But your fulfillment costs, your marketing, your specialized labor, all of that is practically zero compared to a standard retail sale. So you keep a vastly larger percentage of the cash that changes hands. The profit margin expands even as the price tag shrinks.
Well, because structural steel for a border wall takes almost zero value-added processing. A distributor like Reliance, they don't just store metal. Their main value proposition is first-stage processing.
Like laser cutting and slitting coils.
Right, which takes expensive machinery and skilled labor. But a border wall is just raw tonnage. You're just moving heavy, standard-sized materials from point A to point B.
Got it.
So the operating costs per ton were way below their company average. That drastically lower cost structure more than offset the discounted selling price, which is the mechanical reason behind that 30 basis point expansion.
So the border wall boosted margins through low processing costs. But if you strip away that mega contract, you really have to wonder if the everyday bread and butter materials are holding up.
Let's dig into the segment breakdown to see what happens when they actually do have to process the metal. Carbon steel is the heavyweight, making up 55% of sales.
Tons sold were up 7%, but pricing surged 10.5%.
Right. That pricing power drove an 18.2% sequential jump in sales, up to $2.62 billion for the quarter. And this trend of pricing violently outpacing volume is the real story here.
Yeah, look at aluminum. It's 17% of sales. The actual tonnage was basically flat up like 1.1%.
But the pricing climbed 9.8%.
And stainless steel, 12% of sales, volume up 4%, but pricing up 6.1%.
The reason they can force those hikes on flat volume comes down to supply chain anxiety. When the primary mills, the guys actually smelting the metal, when they start extending their lead times, manufacturers panic.
Right, if you need specialized aluminum tomorrow, you can't wait 6 weeks for a mill.
Exactly. You will pay a heavy premium to the distributor who has the physical inventory sitting on the floor right now. Reliance is monetizing that anxiety.
Which makes sense for revenue, but it makes their profit reporting incredibly complicated this quarter. I want to look at this divergence between their GAAP and non-GAAP margins because the financial engineering gets pretty aggressive here.
Oh yeah, it really does.
So the GAAP gross profit margin, the official accounting standard, actually dropped 100 basis points sequentially down to 28.1%.
And the culprit was a massive LIFO expense of $112.5 million.
That's a $1.64 per share negative impact, and management only expected a $1.54 impact. They missed their own LIFO estimate by over $1 a share.
Yeah, so for the listener, LIFO is last in, first out. It's an inventory accounting method.
Meaning when they record the cost of the metal they just sold, they don't use what they paid for it 6 months ago. They use the price of the metal they most recently purchased today.
Right. And because global carbon steel and aluminum replacement costs were rising so much faster than anticipated, their theoretical cost of goods sold just skyrocketed on paper.
LIFO forces you to recognize the immediate pain of inflation. It suppresses the GAAP profit, but it lowers the immediate tax burden, which preserves cash.
But then management heavily directs investors to look at their non-GAAP FIFO margin, first in, first out.
Which calculates profit based on the actual historical cost of the metal. Excluding LIFO, the FIFO gross margin actually expanded to 30.5%.
And pre-tax income soared 41% year over year to $429.8 million.
But I really have to push back on management's framing here. If LIFO is crushing the GAAP earnings by $1.64 a share because restocking is getting so expensive, aren't investors right to be wary?
It's a very common critique.
Because isn't pointing to FIFO just a clever way to make operations look prettier while waving away the very painful reality of inflation?
In many industries, you'd be absolutely right to be skeptical. But in metal service centers, FIFO is genuinely the more accurate metric for ongoing operational health.
Okay, why is that?
Because LIFO captures the macro shock of inflation. It's a snapshot of the external environment. FIFO reflects their internal pricing discipline. So when FIFO expands to 30.5%, it tells you Reliance is successfully passing those higher replacement costs directly onto the end buyer. They aren't eating the inflation.
They're padding your quotes with it.
Exactly. If they were losing market share or customers refused to pay, FIFO would compress because they'd have to absorb the mill costs. The expansion proves they have the leverage to force the price hikes.
That makes total sense. So the next logical question is, who is actually absorbing these massive price hikes?
Let's dive into the end markets to see who's footing the bill. Non-residential construction is their largest market by tonnage.
And management noted significant improvement there, fueled by data centers, energy infrastructure, and public works.
The data center aspect is huge. The physical footprint of modern computing is completely redefining industrial demand.
Because of AI.
Oh, entirely. AI data centers are entirely different beasts from traditional server farms. The new chips run incredibly hot, so you need heavy liquid cooling systems.
Which means miles of specialized copper piping, massive structural frames for heavier racks, and engineered aluminum heat sinks.
The density of metal required per square foot is exponentially higher. Management also highlighted the semiconductor market, noting a meaningful improvement.
Aerospace is ticking up too. Commercial is modest, but defense and space are exceptionally robust. And then there's automotive toll processing, which remains steady.
Toll processing is a brilliant mechanical model we should touch on. In this segment, Reliance doesn't actually buy or own the metal.
Right. A major automaker buys the coils from the mill. Reliance just acts as a highly specialized toll booth. They store it, stamp it, cut it, and send it to the assembly line for a fee.
It shields them entirely from commodity price swings. They just charge for labor and machine time.
And that stability, combined with pricing power, generates massive free cash flow. We have to talk about how they deploy this cash because it actively manipulates the EPS denominator.
Oh yeah, the capital allocation here is key. They generated $162.2 million in operating cash flow in Q2, even with a big working capital build.
Meaning they hoarded inventory to prepare for future shipments at higher prices. Plus, they paid $63.8 million in dividends.
And they declared a $1.25 per share dividend for Q3. Total debt sits at $1.7 billion, making their net debt to total capital ratio a hyper-conservative 16.2%.
It's a fortress balance sheet, but the share repurchase program is what truly supercharges these reports. They actually executed zero share repurchases in Q2.
Not a single share, but you have to zoom out. Since 2021, they've repurchased $3.4 billion of common stock,
That's reduced outstanding shares by a massive 22%.
with $529 million still authorized. Think about the math. EPS is net income divided by shares. Shrinking the float by a quarter in 5 years makes the per-share value skyrocket, even if the business stays flat.
It acts as a massive structural amplifier. When they win a high-margin project like the border wall, the profit flows through to a much smaller pool of shares.
It artificially condenses the value into fewer slices of the pie. It's the hidden reason why that Q3 EPS guidance is so eye-popping.
Speaking of Q3, let's unpack that outlook. Management set the bar incredibly high, but they also pointed out some macro clouds gathering on the horizon.
Yeah, for Q3, they expect demand to remain healthy, but normal seasonality should drive tons sold down 2% to 4%.
And that projected decline excludes the ongoing border wall project. The average selling price is expected to be flat to up 2%, which includes a 1% drag from the border wall mix.
And they gave highly specific guardrails for that federal contract. They expected to contribute another $1.60 per share in Q3.
Plus, they project the LIFO expense to cool down significantly to $75 million. That's a $1.10 per share impact.
So you combine a cooling inflation penalty with the massive margin from the federal contract, and you get that massive Q3 non-GAAP EPS guide of $6.40 to $6.60.
But management isn't ignoring the broader environment. They flagged potential supply availability headwinds for non-res construction.
And broader macro threats, trade policy uncertainty, tariffs, and the conflict in Iran disrupting global shipping.
When management warns about supply shocks, it sounds like a reason to panic. But the counterintuitive reality is that Reliance's scale is exactly what insulates them from those very shocks.
Exactly. When supply chains tighten, the primary mills extend lead times. A customer who usually gets steel in 3 weeks is suddenly told it'll take 3 months.
That creates total panic.
And when manufacturers panic buy, they bypass the smaller regional guys and go straight to the biggest player with reliable inventory.
Which in North America is Reliance.
A supply shock that bankrupts a smaller mom and pop pushes massive volume and pricing power directly to Reliance. Their moat actually deepens during extreme stress.
Wait, is that really true, though? I have to challenge the idea that they're completely insulated from a true macro shock.
Okay, perfect.
Because sure, they have a massive stockpile right now, but if a geopolitical event completely freezes shipping or a severe trade war chokes imports for 6 months, even Reliance runs out of metal eventually. They aren't a mill.
Right. They don't smelt their own steel.
They aren't immune to physics. You can't distribute what you can't source.
No, that is a completely fair distinction. They are not entirely immune to gravity. If global supply literally drops to zero for a prolonged period, Reliance will halt just like everyone else.
Exactly.
But the difference is the time horizon and the survivability curve. A regional service center with tight cash flow might go insolvent in week 3 of a freeze.
Because of limited warehouse space and capital?
Right, but because of their $1.7 billion balance sheet and massive stockpiles, Reliance can survive for months. And they'll be selling existing inventory at astronomical crisis-level premiums.
Okay, so a permanent freeze kills the whole industry, but typical volatile disruptions just wipe out the weak players.
Yes, allowing Reliance to absorb their market share when the dust settles.
Which is the ultimate advantage of having a 16% net debt-to-capital ratio. You just outlast the competition. Bringing it all together, you have a company delivering massive top and bottom line beats. They achieved it through ruthless pricing discipline, layered on top of a highly lucrative federal bulk contract.
Plus generating massive cash flow, shrinking their float by 22%, and a scale that makes them the apex predator in a tightening market.
But I want to leave you with a forward-looking question to ponder as we wrap up this deep dive. We've seen how a massive public infrastructure project like the DHS border wall heavily padded their volume and margins this quarter.
Yeah, and it's expected to add another $1.60 per share next quarter.
Exactly. But what happens when those highly specific federal funds eventually dry up? Are we looking at a looming demand cliff for industrial metals once the government stops cutting checks?
Or, given the physical realities of AI data centers, energy grid modernization, and reshoring, is this just the first inning of a decade-long infrastructure supercycle that won't even need government money to keep running?
That is the real question. If you want to stay ahead of the curve and unpack the mechanics hiding inside the financial data, make sure you follow the show for our daily earnings coverage.